most people that have north of $1 million in IRAs and 401ks are not aware of the future tax problem that you will have in retirement when you're forced to take distributions. In this hypothetical example, we're going to show you how we potentially save them over $100,000 in taxes that they would have paid to Uncle Sam. And in turn, we created potentially $3 million of tax advantage assets that they could spend more, they can leave more to their family, to their kids, to their spouse, and leave a more tax efficient legacy. Now, I've been a financial advisor for 25 years. I've spoken in front of 25,000 people in different seminars, webinars, client meetings, because we're going to show you these, not problems, but just solutions so you too can potentially reduce your taxes in retirement so you can slowly divorce the IRS over time as well. So here's the main issue with taxes that most people are aware of. It isn't about how much money you have, it's about how much money you keep. If you're 55, 60 years old, you've been saving money generally pre-tax in an IRA and 401k for about 20, 30, 40 years because someone told you that when you're in retirement, do it this way because you're going to be at a lower tax bracket. 30 years ago, no one knew what the tax brackets were going to be today. And if you're watching this, if you have north of $500,000 or $1 million or $2 million or $3 million plus in retirement accounts, you could potentially have a tax time bomb and pay more in taxes in retirement. Okay, so let's go back and look at the top US individual income tax rates going all the way back to 1920. And what you're gonna notice right here between basically 1940 and 1980, the top marginal tax rate never dipped below 57%. Now, we always ask, why were taxes so high back then? And a lot of times you could say, well, we came out of, world wars and the Great Depression. We were in some pretty big debt. And the number one revenue stream for the United States of America is taxes. But if you look at today's debt, we are in debt as a country over $37 trillion. We are in way more debt today than we've ever been. But if you look over here, Congress enacted in 2018 the Tax Cuts and Jobs Act. It essentially lowered taxes. So there is no guarantee and no one has a crystal ball. Some experts believe that taxes are on the rise in the future. So if you have most of your wealth in IRAs and 401ks, you could be potentially dealing with higher taxes in retirement. So tax planning is something that your advisor or you should go seek out a firm that specializes in tax planning. And that's something that we do at BAM Advisory Group. Okay, now this here is an ordinary income tax map for a married filed jointly couple that are over 65. And what you're gonna notice in the US tax system is progressive, right? So essentially your first $30,000 or so, again, married filed jointly over 65, first $30,000 is tax-free. That's your standard deduction. But then what you'll notice as you graduate based upon your distributions in the 10%, 12%, 22%, and 24% as you keep going. If you're watching this right now, what you want to know based upon your unique circumstances, when you're in retirement, you're taking distributions from your IRAs and 401ks, you're blending in a pension if you have it, you're going to maximize Social Security. When you have to take your RMDs, are you going to jump from a lower tax bracket to a higher tax bracket? You need to work with a firm that understands this and that can help you, again, mitigate this problem so you can potentially save more money from the IRS and put that money back in your pocket. So now what we're going to do is jump into a hypothetical client example that we're going to show you where if they didn't do tax planning, they were going to jump into a higher tax bracket when they were forced to take their RMDs. Here we have Tammy and Tim's sample. And you can see here, and this is the planning software that we use when we meet with clients. They have about $1.5 million in IRAs and 401ks. Tim has $1 million in an IRA and Tammy has $500,000 in a 401k, and they have about $250,000 in savings. So quickly, we'll kind of go through their facts so you can kind of understand how we built this out. They're both 65. We have their life expectancy living till age 90. Their financial priorities are they want to minimize taxes. They really want to work with a firm that focuses on retirement planning. If you go back and watch some of our previous episodes, BAM Advisory Group, we focus on the 5 worlds. That's 5 key areas that we think are critical for a retiree success. And then, of course, they don't want to run out of money. Again, their goals, in this example, they want about $80,000 in retirement income. And then again, they've got Social Security. This is an example that we see a lot in our office. These folks don't even want to start spending money in their IRAs and 401ks because they don't want to touch the money because they know they're going to pay higher taxes. But the problem is, they're 65, so they have until like 75 before their RMDs are due. If they just leave that money grow, God forbid your money grows, their RMDs are going to jump them into a much higher tax bracket. So we're going to show you that right now. So essentially what we do for any potential person that walks in our office, again, this is a potential client, we showed them here what their cumulative lifetime taxes are from today up until age 90. And if they live till age 100, they're just going to pay more in taxes. So 90. These blue bars right here, they're going to be in a very low tax bracket from the day they retire all the way until they turn 75. You might say, well, David, why does their taxes jump up so high when they turn 75? Because now all of a sudden they are required to take their distributions. Ladies and gentlemen, if you're watching this right now, once you have to take your RMDs, then you're stuck. Because God forbid your money grows, you're going to have to take out more because the IRS tells you based upon their uniform lifetime table that every year you get older, you're going to live less. So now you got to take more money and you got to pay us. Remember, the IRS is your silent partner in your IRAs and 401ks. And they're the ones that move the goalposts. They can change the tax rates. Also remember that this year, Tax Cuts and Job Act, which was enacted in 2018, which essentially lowered your ordinary income tax brackets, is set to expire this year. Do we think taxes are going to go lower? They're going to go higher? We don't know. But tax planning is always a valuable strategy, especially if you have, again, north of $1 million. Our goal, again, these are potential clients, hypothetical situation, is can we reduce your lifetime taxes? Now, if I asked you, hey, if I could reduce your lifetime taxes, would that be valuable for you? If you're not saying yes, it's definitely valuable, right? Then the idea is through the tax savings on your lifetime taxes, can we create more assets through your portfolio tax-free or more tax efficient? This is a hypothetical situation. All these results may vary. We could do this differently. This isn't a one way to do things. It's collaborative, it's dynamic. Your situation's going to change. Your income needs are going to change. The tax codes are going to change. Lots of things are going to change. So we're just showing you one of so many different ways to do this. So in this example, and look, there is no free lunch. With taxes, you either have to pay them now or pay them later, right? You can't just not pay them. It just doesn't work that way. But if we think that tax rates now are low, which they are, and we think they're going to go higher down the road, then why would I want to wait till I'm forced to take them out where then I don't have the flexibility? So in this example right here, we just said, let's pay higher taxes now. So those red bars are these folks potentially paying higher taxes now so that we can down the road potentially pay a lot less taxes later. So what was the outcome? The outcome was potential savings of about $111,000 that you're no longer donating to the IRS, and in turn, creating over $3 million of tax efficient assets. So we essentially created more portfolio assets for them so they could spend down the road, they can pass to their spouse. If you're watching this and you're married, you may have not heard of the widow's tax. Now, if you have IRAs and 401ks and you're married and you pass away, yes, your spouse can inherit those assets at that time, essentially put them in their name and not have to deal with the tax in that moment. What some people don't realize is that when you're married, you file your taxes married filed jointly. That is a much wider tax bracket. But when spouse passes away, the surviving spouse gets stuck in a single filing tax bracket. So now those RMDs that are due are going to be applied to a much more narrow tax bracket. We see people losing tens, if not hundreds of thousands of dollars in taxes over their lifetime when that happens because the spouses didn't prepare for this. You know, $3 million, there's a lot that you can do. So again, your spouse can inherit less money in IRAs and 401ks, so their RMDs are lower. And then, of course, Congress enacted the Secure Act 2.0 in 2020, which made it very expensive for your non-spousal beneficiaries, generally mostly your kids, to inherit your IRAs. Now, your kids have to spend that money over 10 years. And if you have kids that are going to inherit money in their 60s or their prime working years, or now they're in retirement and they're dealing with their own income problems, we like to say at BAM Advisory Group, don't let your money die with you. Do tax planning. All of this money that you saved, all of this money that you sacrificed can be passed down for generations. So now let me kind of show you a chart that shows this more in detail. To the left is these folks doing no tax planning and just saying, okay, well, I'll just deal with the taxes when they come with my RMDs. And the example to the right, the tax mitigation plan is us being proactive about taxes. Look, when you work with an advisor, you work with either one that's proactive, that comes to you with real-time solution, or one that's reactive. We see a lot of reactive advisors that don't even focus on taxes. And this really can move the needle for some people based upon your circumstance, right? The money in the blue is the tax deferred assets. That's your IRAs and 401ks. The money in the dark blue, these people had about $250,000 in cash. So this is their cash. Here, what you're going to notice is that we essentially, and again, it could do this many different ways. The light blue assets go away over a period of time. And then this red is your tax-free assets. This is kind of what you want. I'm sure you would agree with me that if all was equal and if you could pick and choose how to do this, you would take money from tax-free assets in retirement versus taxable assets. The challenge with that is you've been saving money in IRAs and 401ks for 20, 30 years, 50%, 3/4, 80%, 90%, sometimes 100% of people's wealth when they come in our office is all in that tax deferred or IRA assets. So what you're going to see compared side by side, base facts is them doing nothing. Tax mitigation plan is us being proactive and intentional about creating more tax-free assets. So what you're going to see is that the tax deferred assets in your base facts, they just grow, right? They just grow because, these people aren't needing to take money from this, going to be forced to take their RMDs. And if they just leave this money there, the surviving spouse is going to be stuck with a lot of IRAs and a huge RMD that's going to move her or him into a higher tax bracket. And if you pass this money to your kids, they may lose 30 or 40% of it because they're forced to take it out over 10 years. But if we look at this as we go down, and these are tax-free assets in the tax mitigation plan. So you can see when this is all said and done, they might leave their kids $2.3 million in IRAs that they have to take out over 10 years. So how much of that are their kids are going to end up with? 50%, 60%? Again, it depends upon their kids' situation. Again, this is hypothetical. What if we just said, we don't want to deal with that nonsense. Let's leave them with $5.7 million of tax-free assets. Your kids in this example can actually let the money grow for another 10 years before they're forced to take it out. So IRAs and Roths, when they're passed to your kids now, your kids have 10 years to take it out. But if I'm going to inherit a Roth from my parents and I don't need it, I'm going to let that grow 10 years because then I could take that and all the growth out tax-free as well. You tell me what's better. I think it's pretty apparent. Tax planning can potentially win in scenarios depending upon your situation. At least meet with an advisor, or in the show notes, you can click on the link and schedule a complimentary call where we can take you through this process and show you, is tax planning something that could be valuable for you? For some people, it is extremely valuable. And for some people, there's not a lot we can do. At least you know before it's too late. So in my 25 years of being a financial advisor, I was working with people when I started my career that were just accumulating assets. And we just said, save, 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 save. They didn't need their money. Most of my clients were in their 30s, 40s, and early 50s. They didn't need their money for 10, 15, or 20 years. Now, or really for the past 10 years, what I've been noticing, the baby boomer generation that has all this money, $1 million, $2 million, $3 million in IRAs, and they're never going to spend it. So they don't want to take any money out because if they take money out, they pay taxes. But what they don't realize is if you have 5 or 10 or 15 years before you take your required minimum distribution, and you got $1 million in IRA, 5, 10, 15, 20 years later, that could be $3 million. And your RMD, if we go back to that tax map, your RMD is going to be so big, it can move you into that higher tax bracket. So the example that we just showed you, those people were in a low tax bracket between pension and Social Security. They're like in the 10% marginal tax bracket. Their RMD pushed them into the 22% tax bracket year one when they had to take their RMD. Some of you are watching this, it's going to be a bigger problem because you have more than $1.5 million in an IRA. And if you're working with an advisor that is only focused on accumulation, that's one of the big problems. And I highly, highly encourage you to work with a retirement planning firm that focuses on distribution. And that's what BAM Advisory does in a nutshell. We focus on distribution to make sure that you pay the least amount of taxes over your lifetime, pay less to the IRS so that you can keep more of your wealth and pass that money to your family tax efficiently or spend it more. Whatever your choice is, we want to give you all the options.